I got paid $17 to wait around and basically do nothing. So a month ago, I put in an order to sell a put on Ford, ticker symbol F, saying that, let's say we filled this order on March 16th, and it expired on 4/10 a few days ago, and we were saying that if the stock goes below $11, we're going to buy 100 shares of it. But that didn't happen. It expired worthless, which means that I was not forced to buy 100 shares of the stock, and I got to keep the $17. Now, I wouldn't mind owning Ford stock. That's why I'm selling a put on it, and I'm willing to go in at $11, maybe a little bit more. We can look at the stock chart to see what's going on, but you know, it's fine with me either way. If I hold on to that put and let it expire worthless and keep the full premium, that's fine with me. Or if I'm forced to buy the shares, 100 shares of the stock, that's fine with me too. So let's look at Ford Motor Company. Zoom out a little bit on this stock chart. What's it been doing lately? So it's been a relatively low, looking at that low price, notice it's staying above $11 the whole time. So I could go in at probably $11 or $12 on our option chain. So we will click on trade options, and let's go probably about a month out, let's say mid-May. We want to sell a put, so we're looking at the puts here. Current share price is $12.18. I could see easily drop into $12, but we'd still have 66 chance of profit. Or it could go to $11, that's around 80% chance of profit. And the lower you go in this chain, the less money someone on the other end of the deal is willing to pay you to take on that risk, because it's less likely for the stock to actually drop that low. But it has decent volume and decent chance of profits for these. And, you know, I'm going to go for that $11 again. Let's go for that put. And trading around 20 cents per contract. Lots of volume, lots of open interest, and a good chance of profit. So there's only a 20% chance that it'll actually go below $11, and then I'd be forced to buy 100 shares of Ford. So I'm willing to do that. Let's click on sell, and let's do one contract. Let's make it good till canceled, and let's put it in for 20 cents and see if anyone takes that. So this little profit loss chart saying it's $12.18 now. If it drops to $11, the strike price, or if it drops 9.69%, then we start to earn less money on our profit here, and it goes below $10.80, then that's what the profit and loss looks like, which is $1,100 you paid to get into it, plus the $20 you received to get into this deal and collect that premium. So we can click on review. Saying we're putting up $1,100. We're agreeing to buy 100 shares of Ford for $11 each before on May 15th. If you aren't asked to buy F by then, you'll keep your collateral and the full $20 credit. Sounds good to me. Alright, now it's queued for tomorrow. And if they don't take it at 20, I might drop it down to 19. We'll see. That'll be fine with me. And then it'll just repeat this process where we collect some premium to sell that put. If we get assigned, then we own 100 shares of a stock we wanted to get into. And if not, then that's fine. We'll just keep the premium and do it again next time. So thanks for watching. If you like this kind of content, please give me a like and subscribe, and I'll see you next time.